Hello traders, Gary Wagner here. It is approximately 12 noon in Honolulu, making it 5 o'clock in New York City. It is Monday, the 30th day of January 2012, and this is the daily report for gold and silver. We have the precious metals complex in a mild round of profit taking, well off of the lows of the day. We currently have gold trading off about $9, and as you can see, our current print is 1728.94, call it 1729, 1728 in that area. And in silver, we have silver off about 51 cents, currently trading at 33.43. On today's report, I'm going to cover in detail why I raised stops yesterday and the points that I put the stops at. I want to kind of clarify that and show you a little bit of what I was thinking in terms of major support areas. We'll do that all here on today's daily report. Traders, last night, for really the first time since we've seen this rally start, this 2012 rally, we witnessed the metals market under what I consider to be moderate to moderately severe pressure. We had gold down about $20 at some point. I want to start simply by looking at a 30-minute candlestick chart. Every bar represents 30 minutes. And as you can see, when we take a look at the way that this market traded, it had been forming a base. This is about 1680 right in here. And you can see that the market had been coming up. This is about the 20th of the month. And then we had this market come down and test this low. This was 1645. Now, we had this tremendous spike. This is when Bernanke came out. The Fed announced that they were not going to really adjust or change the way that they worked with interest rates. In other words, they were going to keep them low. They also made a statement that kind of hinted at the point that we might in fact see some additional bond purchases, in other words, QE2. And you could see that this market really took off running. Now, when it took off running, it did trade within a range. You've got 1715 on the low and about 1740, this is the high. And what I really want to hone in now is yesterday's trading activity. It's going to pretty much start here. So what I really want to do is go ahead and blow that up for us, traders. And as you can see, when we go ahead and blow that up, and this, of course, this is the beginning of the trading activity. This is Sunday, of course, and today's date on Monday. What I found to be quite interesting when we take a look at this chart, and I'm also going to look at a 720-minute Japanese average chart, you can see that when it got to the top, this is just straight candlesticks, but you've got this cluster of dojis, meaning the open and low are approximately the same. You've got that here and you've got that here. And then on a 30-minute chart, interestingly enough, in terms of a candlestick pattern, you get a candlestick simply called a shooting star. So that comes in here, and then the market sells off, and it sells off actually quite hard because it goes from 1740 down to a low, let's call it 715 to 718, right in that area. And so where did it find support? Well, you can see that it found support right above this initial low that we hit the other day. And from there, we began to see buyers come into the market. And in essence, what you were seeing in that case was a buy the dip mentality. And as I said, currently trading at 1729. So that brings us to my next chart, and this chart that I want to look at right now, it's a 720-minute Henkin chart. I'm going to run it in two different formats. In other words, I'll turn it back into a candlestick before we're done with it. But this is where I'm trying to get some sort of a sub count in here. There's no doubt in my mind that at the beginning of last year, 1229, we absolutely hit the bottom of this market. And you can see this as the bottom of C, or the bottom of that wave 4. It is my belief right now that we have now entered major wave 5. But also, traders, realize that even with major 5, we are probably going to get a series of 5 Elliott waves, meaning we'll get 1, 2, 3, 4, and 5. So obviously the question is, where will these corrections come and how will they play out? Now, when we take a look at a simple Fibonacci retracement, and the retracement that I am drawing here is simply from the beginning of this rally to the top of this rally, which was around 1750, and then I look at different levels, I think you can see quite clearly that it does appear, at least on a tentative basis, that there's some good support. This is 1659 here as it took off, and 1733. So 1633, excuse me. So that these are really our long-term moves if in fact we see some weakness and this market come down. This is where it could possibly go to, but we're a little bit early on that to tell. But the one thing that we do see, now realize the 720-minute chart simply has 2 candles per day, and we are getting that consolidating candle, that doji-like candle, and realize that unlike other markets where I would consistently think that this would be a reversal point, it could simply just be an area of consolidation. So for that reason, I did move our stops up. I moved them below 1700, and in this way, my sentiment is that this market is probably going to make a play for these tops in here at least, and that takes us right around $1,800 per ounce. Now, traders, I have converted that Henkin chart, the average chart, 720, back into just a regular candlestick chart. And the reason I did that is you can see really in this instance how different the candles look. Remember, that was a doji-like candle, but here you get pretty much a piercing line, and you also get typical consolidation in the market, meaning you're going green, red, green. Obviously, we're going to maintain our stops, so stops are loose, but if the market does melt down at any point, we have substantial profits. I certainly don't want to give them up, and that's why I'm constantly monitoring the market for you. Let's get right to silver. In terms of silver, we have silver well off of the lows, but trading around 33.43. I want to start with our daily chart right in here. And what I have done with our daily chart is I have added basically another Fibonacci retracement area, and it's very interesting how they line up. Traders, we of course have been looking at this one longer Fibonacci retracement from the beginning of our February rally to the high that we hit last year, but I've also added another one starting from the same place, but it's going to this secondary top right at 44. Now, what you can see is on the left-hand side is the Fibonacci retracement numbers from the longer of the retracements and the shorter of the retracements. And here's what I'm finding interesting. When we add this, we first of all, you know what I call Fibonacci harmonics. It's where we get 2 matching. And here you have, as you can see, this 61% retracement matches exactly, almost exactly, to this 50% retracement area. That's our initial target area that we're looking at. This is the $35, and this is where I believe we could see silver, in fact, go to. If, in fact, it breaches it, we'll go and move up the ladder, so to speak, the 50%, $38, and then $40. We'll take a look if and when we see the markets go to that point. But what I'm finding interesting is that the 33.24, you can see we're just above it, but as you can see, that's a very logical place for support right in this area. Although we moved our stop well below it, 32.80, this is where I would want to see silver really find support and be able to hold. You can see that it was a resistance area in this point in time back in October. It was support. Remember, support and resistance is simply where you are. When I'm on the second floor looking down, I consider it support. If I'm on the first floor looking up, I consider it resistance. They're the same area. It's simply a matter of your vantage point. So the traders, as long as we maintain above 33.24, I'm still absolutely bullish. There's good history in this area, and this is an area that the market, if it's going to consolidate and not move into a counter or subwave, and what I mean by that is simply 1, 2, 3, in other words, a smaller counterwave within our larger wave. If that's not going to be the case, we'll simply see it form some sort of a base in this area before moving higher. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.